Since the calendar has flipped to October, the S&P 500 has really traded sideways. But for those of you that have taken my options course in the past, you know that I often say the thing I love about options is the fact that there's a strategy to be played. Whether the market's going up, sideways, or even down, we can still profit from it. And today's video is going to be a fun one because we're going to be diving into 4 stocks that I'm looking to buy. But I'm also going to be showing you a few option plays to consider and go along with them at the same time. So let's not waste any more time and dive right into it. But before we do, show your appreciation by just simply clicking that like button down below. Subscribe to the channel and let's roll the intro. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we dive in, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now. All right, let's jump into our video, taking a look at 4 stocks I'm looking to buy, beginning with stock number 1, which is going to be Hims & Hers Health. Stock ticker HIMS. And for those of you that are part of my Options Edge community, you know that this is one I recently fired off an option trade alert to, where I sold a cash secured put on this particular stock this week already. And if you're looking to join and see all of my option trades, then become a member of our Discord that has over 20,000 members. You can be an Edge Plus subscriber or an Options Edge Plus, depending on if you want more stocks info or more options specific info. Check out the link down in the description below. For those of you unfamiliar, Hims & Hers Health is a US-based digital health platform founded back in 2017. It provides direct-to-consumer telehealth services for both ladies and men. The company connects users with licensed healthcare providers who assess needs and prescribed tailored treatment plans, including prescription medications, over-the-counter products, and ongoing care. The business model is built around subscriptions and recurring product sales, focusing on wellness categories such as sexual health, hair loss, skin care, weight management, mental health, and other preventative care segments. Over the past few years, the company has seen substantial top-line revenue growth that has gone from $527 million back in 2022 to over $2 billion in the trailing 12 months, which is a growth rate of 89% from last year. In addition, the company turned a profit from an operating perspective for the first time just last year, and that has doubled so far in 2025. The top-line revenue growth can show that the company has a true product and the demand is there. It's now up to the management team to continue that, but also find ways to become more profitable. When it comes to Hims & Hers, they currently have a market cap of $11 billion. Over the past 12 months, the stock's been on fire, up 130%. In 2025, up 105%. It's great to see revenues and all, but I also want to focus on debt and ensure a company doesn't have major debt issues. And when it comes to Hims & Hers, even though they're a young company, they don't have any debt issues. Because as you can see here from this chart, the company actually has more cash on hand than debt, putting them in a great financial spot. Now taking a peek at valuation, where as you can see here, the analysts' average estimates for the coming years. In 2026, EPS estimates on average are around 81 cents per share at a growth rate of 38%. In 2027, that ups to $1 per share at a growth rate of 24%. So that gives us a 2-year average growth rate of roughly 31%. Using the 2026 EPS estimate, this has the stock trading at a forward PE multiple of 62.8 times. And with a 2-year average growth rate of 31%, that gives the stock a PEG ratio of roughly 2, which is a little on the high side. As such, when there's companies that I love the financials, I love the growth, I love that there's not a major debt issue by any means, I want to be interested in them, but valuation has to make sense. And at current valuations, although I could see maybe nibbling at the stock here, I would like to buy it at a much lower entry point. And that's where options comes into the equation. So when it comes to these types of situations, I love to sell cash secured puts. What they do is allow me to potentially purchase a stock that I want to buy at a price that I want to buy it at. And I get to earn income along the way while I wait. Here's a look at the alert I gave to my Options Edge Plus community earlier this week. I sold the November 21st $40 put option and generated $2 per contract, which equates to $200 per contract at a 17 delta. So trying to be a bit more conservative here given the overall market conditions. And that's going to lead us to stock number 2, which is going to be SoFi Technologies. Stock ticker, SoFi. And this is a stock that I absolutely love and believe it is a game changer when it comes to the banking or the financial industry. It's really been trading between as high as $30 just in the past couple of weeks to below $25. So those are big moves that we've seen in just a few weeks here. I would love to own the stock more at that mid $20 range. SoFi is a company reshaping the banking industry as we know it today, and they have a lot of momentum. They offer banking services, credit cards, investment opportunities, and loans. It's a digital one-stop shop. And as you can see here, popularity continues to grow as members are growing at a fast clip from 3.4 million in 2021 to 11.7 million as of their Q2 earnings in July. Looking at the financials, we see revenues continuing to climb, EBITDA continuing to climb, and net income continuing to climb and turn a profit. EBITDA margins are sitting at a very healthy 29%. Not only is this a company that's growing revenues, growing its products, and becoming more popular, they're finding ways to do it while also becoming more efficient. Everything lining up that I love to see in a company before buying its stock. When it comes to SoFi, they currently have a market cap of $31 billion. Over the past 12 months, shares are up nearly 170%, and year-to-date, up 86%. Wow, with returns like that, Mark, you're still considering buying this stock? Absolutely. And that'll be a good transition into valuation because looking here, you can see the analyst average estimates. We need to not put so much attention on past performance and look at valuation moving forward. And as we can see here, analysts are looking for the company to generate EPS of 55 cents per share next year, which would be an impressive growth rate of 74%. 2027 EPS estimates are at 76 cents per share, and that's a growth rate of 37%. But when we iron those out, a 2-year average is sitting at 55%. So using that 2026 estimate, that has the stock trading at a forward PE of 52 times. And with a 2-year average growth rate of 55%, this gives the stock a PEG ratio of less than 1 at 0.94, which is showing you that although you're paying a high premium, it's backed up by growth. So right now, you could absolutely buy this stock here, even with the run it has had. However, for me, I want to be a little bit more patient, given the market conditions, seeing that maybe we could potentially get a bit of a pullback. As such, I want to sell a cash secured put, looking to enter this stock in the mid $20 range. So here we go again. Let's sell a cash secured put. And as you can see the option chain on your screen, we're going to sell the November 21st $25 strike, which will give us around $1.20 in terms of premium, which equates to $120 per contract. This will allow us to earn income while we wait to purchase the stock at $25 per share. And that's going to lead us to stock number 3, which is going to be Taiwan Semi, stock ticker TSM. This company doesn't really need any introduction whatsoever. And the great thing about Taiwan Semi that I often say, especially within my Discord community, is the fact that when you invest in Taiwan Semi, there's not really a winner that you have to pick when it comes to semiconductors. It's not NVIDIA versus AMD, or AMD versus Broadcom, or Broadcom versus Qualcomm, and the list goes on. Because Taiwan Semi produces those chips for all of those companies. They produce, in fact, roughly 90% of all semiconductor chips. The company is one of the largest on the market today, with a market cap of $1.5 trillion. And over the past 12 months, shares are up over 40%, year-to-date up 50%. Again, when it comes to investing, far too often investors look at past performance and say, well, given that I'm up 50%, I should just take profits because it's not likely that this stock's going to continue. And you don't know the number of people that I talked to early on, years ago, when NVIDIA was up over 100, 150%, and they sold the stock because they said, hey, I want to take my profits without even considering the valuation. And we sat through step by step and looked at the valuation. And what I told them was the fact that right now, at that time, a few years ago, NVIDIA was actually cheaper at that very moment than they were 12 months prior. And what happened in the 12 to 24 months since then? The stock has more than doubled, quadrupled in fact. Past performance is not indicative of future performance. And this stock today even is still not that expensive. And getting back now to Taiwan Semi, you can see just how strong their results have been. Revenues continue to rise. Operating profits continue to rise. Operating margins extremely strong at 48.8%. And all of these charts and data you can find with the help of Fiscal AI, which in my opinion is the best investing resource anyone could have. And you could get yourself 15% off by using my link down in the description below. Transitioning now to valuation, where looking here you can see analysts' average estimates for the coming years. 2026 EPS is expected to come in at $11.49 at a growth rate of 16.6%. 2027 EPS at $14.13 with the growth rate picking up to 23%. So that 2-year average growth rate is sitting right around 20%. So using the 26 EPS estimate, that has the stock trading at a forward PE multiple of 25.9 times. And with that 2-year average growth rate of 20%, gives the stock a PEG ratio of 1.3. It is definitely a decent buy right here at these particular levels, but I would love to purchase this stock around the 255, 260 range if I were so lucky. As such, we're going to utilize options again, and we're going to sell a put and see if we can get a dip in the near term over the next month. So what we're going to do is we're going to sell the November 21st 260 strike, which is going to earn us around $3 in premium. So we're earning $300 per contract with a potential opportunity to buy the stock at a lower price around $260. That would be a win-win for me in this case. And that's going to lead us to stock number 4, which is going to be Mercado Libre, stock ticker MELI. Mercado Libre is based in Latin America, often referred to as the Amazon of Central America. They have a large e-commerce business with big reach in Brazil and Argentina and other areas in Latin America. Now, although Mercado Libre is an e-commerce business with a focus on Central America, they also have a payments processing platform as well called Mercado Pago, and that is also growing at a fast clip. So they're the Amazon of Central America, the Shopify of Central America, the PayPal and Block of Central America as well. And you know me, I often talk about it here on YouTube, is the fact that I love investing in companies that are diversified. They're not a one-trick pony. In the last month, shares of MELI have fallen more than 15%, making this a potential great opportunity to add a great growth name outside the US to your portfolio. And looking at the growth in this company, tell me you're not excited. Revenues have gone from $2.3 billion before the pandemic to $24.1 billion the past 12 months. Operating profits were non-existent before the pandemic and now sit at nearly $3 billion in operating profits. Looking here, you can see average analyst estimates for the coming years. 2026 EPS at $66.58. That amounts to a growth rate of 50%. 2027 EPS at $89.03. That's a growth rate of 34%, giving the company a 2-year average growth rate of roughly 42%. Using those 2026 figures, this has the stock trading at a PE multiple of 31.5 times on a forward-looking basis. And with that 2-year average growth rate at 42%, gives the stock a PEG ratio well below 1 at 0.75, giving you a very solid discount on the company's growth moving forward. Now, with this company, they have a very high per share price. So given that, I'm not really going to look or be interested in options. Number one, the volume's just not there, but it would also take a huge amount of cash on the sideline in order to even play options from this standpoint. So this one's strictly going to be a buy in this scenario. So there we just looked at 4 very different companies. I gave you the odds of buying, and I also gave you the option of utilizing options. Let me know what you think of this video down in the comments, and which of these 4 companies are you looking to buy? And are you buying them outright or utilizing options? Thanks again for watching. If you found any value, quickly show your appreciation by clicking that like button down below. It doesn't take much effort at all, but it greatly helps the growth of this channel moving forward. Thank you guys for the support, and we'll see you in the next one. Take care.